There's been a lot of discussion, some good and some obviously very bad, around what's happening in the banking sector. We've seen Silicon Valley Bank and Signature Bank get taken over by regulators in the past few weeks, as well as Credit Suisse being sold to UBS, Silvergate Bank, which is a crypto exchange and a bank affiliated with it, fall as well. And then there have been a number of banks who've been put on alert, First Horizon being one, and recently Deutsche Bank. So what's happening in the banking sector? Well, I'm about to tell you what's happening and how this impacts and affects you. I'm Dr. Dale Herndon. I'm a professor of finance, economics, and global business. And I'm also the founder of Investing Essential, an online financial literacy program. So join me as I explain what's happening in the banking sector and how it impacts you. Okay, so the banking crisis, what's next? Sorry about that. So we're going to talk a little bit about what happened and why it happened. How's it being addressed? Is it a problem? Is it being contained? So I want to start with a rather academic view of things. That's because I'm an academician. Please don't take this as being too far into some scientific theory. There's this thing called the yield curve, and what it tells us is what's the return of a bond based on its time to maturity. So if we had a bond that was yielding 3 months, what is the return on it versus the return on a 30-year bond? Generally, in normal economic conditions, what we want to see is that the returns, in what we call yield in this case, is going to be higher for a longer term bond. So for example, if you have a short-term bond, something that 3 months, you should expect to get shorter or lesser return than you would if you were holding a 30-year bond. The reason for that is because you have inflation that could come into play. You have a default risk issues that you might not get paid on a 30-year bond. It could get called or something else like that, but the company could just go under. A number of issues on why somebody has to get paid more to hold a 30-year, a longer-term bond. Doesn't have to be 30 years. Okay, so this kind of makes sense. You have a short-term bond, you're going to get maybe a quarter of a basis points, and here, a 30-year bond, maybe you get somewhere closer to 3%. So that would be a normal environment. And in a non-normal, abnormal environment would be what's called an inverted yield curve situation. And this is where shorter-term bonds have higher yields than longer-term bonds. And as this example shows, is that a 3-month bond has maybe the 3% return, whereas the 30-year has only a quarter of a basis point. So this is extreme, but it's to show the picture of what's happening. Unfortunately, this is kind of the market that we're playing in. I'll explain that to you in just a moment. But what this curve is telling us is that if you were a short-term investor, if you had cash sitting on the sidelines, you would do better to take it out and invest it in something 3 months, 6 months, 1 year than you would to go and invest it. And so because you can get a higher return, you can get 3% versus having it just sit in a bank account and get 0.25%. So this is very appealing to investors and depositors and banks because they can get a higher return on their money, and when they don't need the cash necessarily, so they could tie it up for a year, not for 30 years. Okay, so this is an unnormal condition, but unfortunately, it's what we're seeing now. So let me show you what the yield curve looks like today. Here we have March 18th, 2022, and we see that the short-term rates, 2-3 months, something like that, are kind of going up, and then they flatline between 2 and 10 years. And this is a key point to make. The 2 to 10 year range is what analysts look at. They want to see that hump is really big at this point. So it's kind of growing up pretty high in there because banks want to borrow in the short term, lend in the long term. They're looking at 2 to 10 years. Now, unfortunately, what we've got is an inverted yield curve. So yes, it's short term is kind of 4.5% or going up to 4.5%, but then the longer term bonds are yielding less than these shorter term bonds. And that's not a good case. And in addition to that, it's higher than the rates that we had a year ago. So what does this mean? Well, if I'm a short-term investor or I'm an investor, I have assets in a bank account, I'm going to pull it out and go put it in these higher yielding accounts, get 4.5%, 5%. And so if I do that, well, I'm taking my cash out of my bank account and putting it into a CD, a bond, or some other fixed income instrument. People are doing that, and that's where the problem lies. Is that these banks a year ago had taken your money. They don't want it sitting in cash. Yeah, it says cash on your balance sheet or your bank statement. But what the company or that bank has actually done is taking the cash and invested it into something. So they invested in a long-term asset of some sort. Maybe they invest in a company or something else. Many of these banks, particularly Silicon Valley Bank and Signature Bank, didn't have anywhere to invest it. All the companies they were funding in their bank accounts or were tailored and geared towards venture capitalists, or in the case of Silicon Valley Bank, venture capitalists and startup enterprises, and they were flush with cash. So the bank had to do something with that cash, and what they did is they bought treasury securities and other fixed income securities just so they could get some return on their income. So it wasn't sitting there, because if your cash is just sitting there on a bank statement, it's not doing any good for the bank. They needed some return. Now the issue is they bought they took your money and they invested it somewhere in like this 10-year range. Well, now that 10-year range is much higher than what they have on what they invested in, and as a result, if they have to sell those bonds, they're gonna have to sell them at a discount. In other words, they have to lower the price to do it, because if you're a consumer and you could get, or you're an investor, and you could get a bond yielding or returning somewhere around 3.5% versus 2%, which would you pick? Well, you're going to pick the 3.5%. So in order to compensate for an investor for this deficit in the difference in the prices, so they got to account for this difference in the yield by lowering the price. That's what I'm trying to say. So they have to lower the price of that bond in order to get cash for your deposits, and that's what we're seeing in the marketplace. A lot of individuals have said, well, I want to buy bonds and things like that are at 4.5%, 5%. And so the bank has to sell these bonds that they had out here at a loss. And that is what's causing the big problem, because the banks are realizing losses when all these deposits are being taken out. However, well, I'll get to that point in just a moment. But what we see here too is I mentioned about the 10 and the 2-year. In this case, the difference is not that big. It is flat. That's not a good sign. But here it's inverted. That is a very bad sign. Banks can't ultimately, they can't borrow at low rates and lend at long term. And so this is what's happening out in the marketplace right now, where investors are coming in saying, hey, I want to borrow, I want this higher yielding security in the short term, and banks have to end up selling potentially at a loss their assets to cover those depositor demands. Okay, that's what's happening. All right. So getting to my next point is, why are investors buying short-term bonds and CDs? And so the Federal Reserve has been increasing its short-term interest rate in order to curb inflation. So when they say the discount rate's moved up, well, that's putting pressure on that short-term rate. It's making it go up, and the long-term rates are not catching up to it. So that entices investors to take their money out of cash and invest in short-term bonds, CDs, things like that. But the bank has to sell securities it invested to meet the cash demands. And unfortunately, many times, or what we saw with Silicon Valley Bank, is the bank's investments are sold at a loss. In a matter of just 36 hours, Silicon Valley Bank went under because too many people took their money out in too short of a time period, a typical run on the bank. Okay, so the question is this contained? Will this continue? Because if it does, it's going to put pressure on the banking sector. Other banks are going to have to go out there and do this. The Federal Reserve is providing loans to the banks to fund depositors' withdrawals. It's called the Bank Term Funding Program. What they're telling banks is, hey, you can borrow money from us to cover, instead of selling those securities, you should borrow from us and you give the money to the depositors. So if I go and I say, look, I want my $10,000 to go buy a bond, and the bank has to start selling assets to meet my demands plus everybody else's, they're going to need some kind of an investment to cover that. So the Federal Reserve stepped up and said, we're going to do this thing called the Bank Term Funding Program. They're going to meet not just the requirements of the 250,000, or they will meet that requirement for sure, The question is how much more than that. But doing this will, the plan is that it's going to instill confidence because depositors will see that they can get their money. So they aren't going to get too worried that if banks are starting to go under, they can't get access to their money. A couple of people are starting to say, though, hey, this is not good in the long term because the Fed has a high spike in loans that it has to cover now. It's giving these loans out to depositors, and it's quite a significant amount. And then it ultimately it shifts this loss to the Federal Reserve because the Federal Reserve now has to accept that responsibility, and somehow somebody's got to pay that difference. Well, it's going to be will be the Federal Reserve indirectly, and that's not a good thing because the Federal Reserve has been lending out a lot of money already through their fiscal stimulus packages that they did back during COVID. That put a lot of pressure on the Federal Reserve's balance sheet. So people are wondering what's happening. Okay, I hope that gave you some background on what's happening. Reach out if you have any more questions. I'd be happy to try to answer them. But that's the banking sector and the world that we're experiencing right now. I'm Dr. Dale Herndon, and I look forward to hearing from you.